All right, welcome to the Hudson Board of Trade. Today we're doing a trade for someone I call Cap. He's a neighbor of mine, and he's always interested in what I'm doing. So he follows a stock called Smucker's, SJM. It's currently trading 107, and he thinks it's going to go lower. It's hard for ordinary people to sell stocks unless you're using derivatives. So he thinks it's going to go lower, and it's going to happen sooner rather than later. So we're going to do this trade in October. The symbol is V. And the 52-week high is 128.5. 52-week low is 91, okay? So what I have drawn here is a -1 slope, right? And that's a short stock position. If I sell a stock at $107 and it goes down to $100, I can buy it back in and I can make $7. So I have profit on this axis, losses here, and stock price here. Okay, so now that we know that, I'm just going to clean it up a little bit and take away this line so we don't get confused. Now we still have our -1 slope. And what I'm going to do here is I'm going to draw a little gap in this line. Okay? And I'm going to draw a line here, and this is going to be the 105 put. Right? We're going to buy this. I'm going to put a little plus sign there. And it costs us $1.45 to buy that put. And I think it's going to go down, but probably not all the way to the 52-week low he was saying. So I'm going to sell, this is a graph of selling a put on the 95 line. So the 95 put in October, which is V in both, I'm going to sell that, put a little minus there, for 25 cents. Now I have a -1 slope from the put I bought. I have a +1 slope from the put I sold. I can add these slopes up. I get a 0 slope. 0 slopes have flat lines. So this is what I'm left with, a graph that looks like this. Okay, and I collected 25 cents, I paid out 45 cents, so that put spread cost me $1.20 for a 10-point put spread in Smucker's. It might be a good trade there, but we're gonna try to make it a little bit cheaper by taking a little bit of risk on. He doesn't think it's gonna go above 110. So when I do this graph, that's the graph of a short call. So I'm going to sell the October 110 call, right? And I'm going to collect $1.50 when I sell that call. Now, just like I'm short the stock, I'd have risk on up until infinity. That's safe for beginners. So what I like all my students to start doing is selling call spreads. So I'm going to buy the 115 call in October. The symbol is V. So I have a -1 slope from the call that I sold. I have a +1 slope from the call that I bought. I add these two slopes up, I get a 0 slope. 0 slopes have flat lines. So I'm left with a short call spread. I collected $1.50 and I paid out 40 cents for this 115 call. So that means I collected $1.10. So I have to pay $1.20, but I collect $1.10. So that means this trade costs 10 cents per share. My max risk is the 5-point call spread. With the 110 call versus the 115 call is $5, right? So I have $5 of risk per share, and I can make $10. My max profit is $10 less the 10 cents I paid, or $9.90. And that happens if Smucker's is below 95 on October. Man, thanks for taking a look at this. I hope this makes sense. This is about repetition. It's not that hard or that difficult. Call is the right but not the obligation to buy. Put is the right but not the obligation to sell. Keep on trading and you'll definitely get it. If you thumbs up my videos, comment, and thank you for subscribing to my YouTube channel, Hudson Board of Trade. Appreciate it.